started. I want to thank everyone for being patient. Well, welcome everybody. Thanks for being here this morning. Had an excellent turnout for today's webinar. I especially want to thank our special guest today, Ray Russo. Ray, thanks for being on this morning.
My pleasure, Charlie. Thank you.
So we're going to go ahead and get started. For those of you that came to us via the Mike Harris radio show, I want to say welcome. Mike Harris has a talk show here in Los Angeles on KFWB News Radio every Saturday morning at 11 o'clock. The topic is, of course, real estate. And Mike is now promoting our webinars to his audience. And so if you're here from the Mike Harris radio show, just want to say welcome and thanks for being on with us this morning. I've done several hundred of these webinars over the last 4 years. Just the topic primarily being real estate, just the current state of the real estate market. I have on a number of different guests from time to time talking about what they're doing in the real estate market, with the way they see the market. Of course, this morning we've got Ray on. I've done webinars with people like Summit Assets Group, Aria Reseller, Ray, of course, with Robinhood Financial. Be on the lookout. We have 2 webinars coming up in 2 weeks from now with both Accuplan and UDirect IRA. If you've considered investing in real estate using your 401k or self-directed IRA, Accuplan and UDirect IRA, that's what they do. Those are typically the 2 groups we refer people out to if they're looking to set up a 401k or a self-directed IRA. But we have a number. I think we have a series of 6 webinars coming up with them at the end of the month, so we'll be looking for those invitations. I've been a guest twice on Real Estate 360. It's a radio show carried up in San Francisco on the Wall Street Journal Radio Network. Why would they ask me? I work with both small investors, people like yourself who may be considering buying a piece of real estate as part of your investment portfolio or your retirement portfolio. But I also work with large institutional buyers with buying real estate in groups. And they typically don't buy in mass groups anymore. We're going to talk about that a little bit today, what the hedge funds, what some of the foreign investors are doing in today's market. But I have real good experience working with those larger institutional buyers. And then again, Meridian Pacific, we had one with them 2 weeks ago. If you're looking for more A-type properties, I would ask you to get a hold of us and acquire the YouTube video of that webinar with Meridian Pacific. They are in the Memphis, Tennessee market. We're going to talk about that a little bit today. But Meridian has a very, very good, high-quality Type A type investment real estate portfolio available. Had a a series of very good webinars with Meridian Pacific just a few weeks ago. Today, I want to welcome Ray Russo. Ray's a financial planner. He's a real estate broker. He understands the financial markets as well as the real estate market, so it's kind of a natural tie-in today to sort of talk to you all about what you may be doing with your investment portfolio or retirement portfolio. So, Ray, thanks so much for being on with us today.
Charlie, it's my pleasure. The stuff we talk about here is pretty important stuff, so if you'll move to that first slide, we can kind of get going. Now, there's a bunch of reasons why I believe real estate is not just a good investment, but a great investment, especially in the world we live in today. That we have markets, the stock market, where many people invest. They have their 401ks there. Charlie, if you go to the next slide, please. They have their 401ks there, and we over the last 10, 15 years, since the beginning of 2000, we saw a very volatile stock market, and it hasn't changed. And you have to ask yourself, with the globe being in the debt levels that it is right now, where is the future? Are you really better off having money in stocks and mutual funds that own underlying stocks and bonds, which is simply a paper asset that you have no control over, which many Americans today are doing? They're too heavily invested in their 401ks, or this is the only thing they have going in many cases, and they're not actively managed. So the returns that you could have over time are going to be less, and they're going to carry more risk with it. And so my thinking is that if you're looking to build wealth, or if you're looking to build any sort of financial freedom, and by the way, 96% of the population is either dead or dead broke today. In America, the nation has created more wealth than any other country. The next 6 countries combined has very dismal retirement statistics. So 96% of the people are not ready for retirement, and only 4% in this country are financially independent today. So my goal here in having this conversation with you is to get you thinking a little differently about the kind of things you invest in. And most people, if they think about real estate, they think about the complications of investing in real estate, and that it's a big purchase, and if they don't know what they're doing, they're going to get hurt, this kind of a scenario. So I would suggest that the reason we're here is we've taken all of the problems, Charlie in particular has taken away all the problems associated with investing in real estate. So this is very sound thinking, and where possible, owners of 401k accounts ought to think about adding real estate. Now, you can't do it with your company 401k unless it's specifically set up as self-directed, and almost none of them are. So you have to ask yourself, how do I get my 401k money to diversify away from simply open-ended mutual funds or stock investments and get into something that's considered a hard asset? Now, today there's a couple of ways you can do that. If you have old 401k money and you're no longer working for the firm, that money can be transferred via a 1035 exchange or a trustee-to-trustee transfer, I should say. And that trustee-to-trustee transfer simply goes from where it is to a self-directed IRA where you could begin to make real estate investments inside your IRA, as well as a host of other things. So we highly recommend you do that. Of course, if you're going to invest in real estate, it's really best to own it outside of a qualified plan, and I'll get into that here more in a minute. If you'll go to the next slide, Charlie. Charlie, you there? Oh, I thought Charlie fell asleep at the switch. Okay, so real estate is a hard, not a paper asset. And what does that mean? Well, first of all, it means greater control, right? You can see and touch real estate, and you can have a say in what you buy, how much you pay for it, what you decide to do with it going forward, whether it's going to be you're going to flip it right away for a profit, because the properties that Charlie and I are involved in are wholesale properties. So you're getting a great price. You can literally turn around and flip these properties and make some pretty nice money. Or you can hold them a little bit longer term. You can do any number of things with it. And so what you decide to do going forward with your property is simply up to you. You have some choices there. On the other hand, compared to, say, a 401k, you have no choice over what stocks the investment manager of that fund buys or sells on any given day. And frankly, they're not really actively managed. They are only from the standpoint of them buying and selling new stocks all the time, but the securities laws, in particular, that deal with open-ended mutual funds, are somewhat restrictive for the investor. And it's good for the economy because there's some safeguards built in. For example, any fund cannot go into 100% cash if he sees something wrong with the economy. Like we're looking at these debt levels we're having, and you might say, well, why doesn't my investment manager just go to cash and play it safe right now? Well, they can't. Because if every investment manager had that ability, the economy would crash overnight. So the laws are in place to protect not only you as the investor through the broad diversification available inside of a mutual fund, but also to protect the economy from collapsing overnight, because companies cannot simply do a broadcast, overwhelming size distribution order from a mutual fund. In other words, if they just liquidate all the stock, how are they going to redeem? How are they going to find all that money to redeem all the stocks that people hold? So it's a non-issue. And then further, you can't invest any more than 5% in any one company or 25% in any one industry. So you can see that they keep you in the fund for the most part. They may increase their cash holdings, but that's all they can do. So if the market is tanking, or if the market's correcting severely like it did in 2008, where we lost about 50% in 30 days, then you're going for that ride, unless you physically yourself or whoever you have managing the assets moves that money. And frankly, most of the people in the industry, they're trying to be asset managers and asset gatherers at the same time, and that's a huge conflict of interest. So the point is, if you want more control, if you want to get away from paper assets for which you have no control, and for really all intents and purposes, the laws are working against you in that regard, because you have active managed accounts today that are quite different. That's not the subject of our discussion. Real estate is today, but the point is, if you want greater control, if you want something you could see, smell, touch, feel, and have some decision about what to do with, then real estate is the way to go. And so today, in a fractional reserve banking world that we live in, we all understand that the smartest thing to do today is to convert paper assets that were literally created from nothing. The formation of the Federal Reserve in 1913 was a rigged game against the public. It was a good old boy scenario with the bankers and the U.S. government, where the bankers would provide all the money possible for the government to run and operate and, of course, do whatever shady deal they want to do. And the government would provide the taxing authority on the people. And so we know that these paper assets, the notes that you have in your wallet, are virtually worthless right now and can be at any time. And most people don't see that that's possible in America, and I'm here to tell you it is. You know, we did have a Great Depression once, and we have had a central bank system twice before. Both have failed miserably. So if you can access real hard assets this is a way better scenario, especially in the environment that we live in today. Real estate is tangible. That's where you should be. That's where you should have at least some of your assets to really, really diversify properly. Next slide, Charlie, please. So, real estate is a better tool for also planning your estate. If you have qualified plans, adding real estate will make them work better and be more balanced, as well as providing ongoing income for rent that likely exceeds what a dividend-paying stock will do. So, you might get somewhere between 4 and 7% dividend-paying stock, but we're talking about ROIs here on properties anywhere from 12 to 20%, depending on the property and what you buy it at and what the rents are going for. But that's about the range of the net rents that you're going to get from these properties. And so adding real estate is from a ROI standpoint, from a diversification standpoint, from a hard asset standpoint, it's all a way better situation. Also, real estate gets a step up in basis on death if owned by a living trust. And again, you can't do this if your real estate is inside a qualified plan. In fact, a qualified plan is specifically designed to be titled in the name of an individual, not an entity like a trust. So you can never put a qualified plan, even if it owns real estate inside of it, you cannot put a qualified plan in a trust. The most you can do is make the trust the beneficiary. You can also do things with real estate you cannot do with anything else. And in combination with one specific type of financial tool, you can defer and in some cases eliminate taxes altogether. This is a 1-2 punch that I believe in the 21 or so years that I have been in the industry, you learn things. You see what works and you see what doesn't work. You see how what laws are favored for certain investments compared to others. And this investment I'm talking about, again, it's not the subject of this discussion, but when you combine real estate with that, you could be looking at deferring or eliminating taxes for the rest of your life. And there's no other way that you can do that. Really none. Charlie, next slide. I think that next slide is you. So I'm going to basically now turn it over to Charlie. I've said my piece, but we're going to be remaining after this webinar. So any of you have any questions related to real estate or the planning side of this whole thing, whether it's for Charlie or myself, we'll both be here to answer any questions you have. Charlie, thanks so much.
Yeah, thanks a lot, Ray. And what Ray just talked about there, it's really interesting because as you were saying that, Ray, I was thinking that when you deal with these institutional buyers, a lot of the reasons that they're buying are the same reasons you just listed. I'll sort of go through that as I go through my presentation. So, one of the common questions I get asked now, we're in 2014. The housing market sort of crashed in 2008. And a lot of people will say, did I get in too late? That was, 6 years ago. And did I miss the peak buying opportunity? And it's a good question, actually. If you think about it, we do know, if you attended any of these webinars in January, February, the only thing I focused on was the market in 2013, where we've been. Just, where's the market been? Where did it go in 2013? What markets appreciated? We saw pretty much across the board a 12% appreciation throughout the market in the United States. Some markets, like where I sit, I'm in Orange County, California. Orange County appreciated over 20% in 2013. Las Vegas, Phoenix, some markets like that appreciated 20+%. So, it's a natural thing to ask, is this a good time to buy? We're going to focus in on it a little bit today, why we're seeing so much money continue to pour into buying investment real estate. And one of the reasons is certainly is the hedge funds, and it goes, Ray, it's just going to tag on what you were saying there. And I'll save that for a couple slides from now. But what you're seeing here is you're still seeing institutional buyers buy up real estate in record numbers. Just to give you a number, in 2013, the hedge fund buyers acquired $9 billion in residential real estate. And it's kind of this cartoon sort of applies. A hedge fund, a guy that specializes in highly complex derivatives for exotic financial instruments for that discriminating investor, and he says buy gold. Essentially what he's saying, it's the simplest thing that makes the most sense in this market today, and Ray was talking about that. These guys will talk to you about their strategies, and I'll talk about that in a few slides here, but they'll talk about why they're buying real estate, and some of it, Ray, is exactly what you said. A lot of what's in the market today is there's a fear out there in the economy as to where the best place to have your money is. Blackstone, if you don't know who they are, by the way, they are the largest owner of single-family homes in the United States. They have 31,000 homes in 13 markets across America. John Paulson's the guy that accurately predicted the housing market was going to crash. He's now one of the largest owners of single-family homes. He has hundreds of millions of dollars of his own dollars invested in real estate. If you don't know about what Warren Buffett's done with the housing market, you should know that in 2012, Warren Buffett purchased Prudential Real Estate. Now, he did that as part of a grander plan. He certainly recognized the opportunity that existed in buying real estate, but he also knew that to be successful, he had to have partners, and Ray alluded to that a minute ago, too, when he said that, you have to have the ability to have infrastructure to be successful, and you got to have partners and people you can connect with that will help you do that. That's all true. Warren Buffett saw that same thing and said, well, it's a great investment, but to do it, you have to have an infrastructure, people that can manage the property for you, people who can find you the best deals on property. That infrastructure is critically important. Property Direct and Havenbrook Homes are two of my biggest clients. They're both hedge funds. They are in 7 and 8 different markets, respectfully, across the United States. I sell more homes. Havenbrook is an example. They went under contract with almost 40 homes last week. So large buyers of investment real estate. And, when you say, well, why are the hedge fund guys doing this? And I search for this all the time. I do a lot of research, not just in talking to hedge fund managers, but also just on the Internet, what's available out there. What are they saying as to why they're so heavily invested in real estate? Here's the simple answer. The simple answer is it's just the best investment in America today. There's just no place they can go to find a better opportunity than real estate. You're buying at great prices. The market's appreciating. You get great cash flow. There's tax benefits. I'll go into the reasons in another slide, but they just simply see it as the best investment they can make. Blackstone, as I mentioned, they've raised the largest opportunistic fund ever raised in the United States, $13.3 billion, 31,000 homes in 13 markets. I've mentioned Warren Buffett. If you Google Warren Buffett on real estate, you're going to see a lot of quotes, and certainly I could spend 30 minutes just doing that. And I have done that. I've spent some time on these webinars just talking about what some of these respected large investors are saying about the real estate market. But the one thing you hear Warren Buffett say more than anything else is he says that we've made progress, but the market's far from recovered. Yes, it's improved, but it's got a long way to go. He's even actually been quoted as saying that he thought that the market would recover faster than it has. Now, depending upon which crystal ball you want to rub, some folks will tell you that by 2017, the market will get back to its previous peak. Others will tell you it's as far off as 2021. But regardless, what the common opinion is or common thought is that the market's going to get back to where it once was, and they want to be along for that ride. Ray mentioned the ride in the real estate market. You've got some volatility there. Well, these folks see the housing market as the complete opposite of that. They see it as, yeah, you're on for the ride all right, but the ride's going back to where it once was. John Paulson, I mentioned him. He was the guy that accurately said the market was going to crash, that bet heavily against it and then profited off that. But he was just recently quoted as saying he still thinks buying a home is the best investment anybody can make, and its affordability still at an all-time high, and I think that's all absolutely true. Some of the reasons why they buy, and I'll go through this quickly, but I want to circle back to what Ray said. Yes, inventory is at historic lows. You can get great deals. I'm going to give you some examples on great deals in a few slides. The market's appreciating. It's going up. You're buying into a market that has been down. History tells us that it's going to continue to climb back up. And so the markets are appreciating. You get a great ROI. I mean, where do you get 10 to 15% cash-on-cash rate of return on your money along with your asset appreciating every year? There are tax benefits. Now, I can't speak to that. Ray may be qualified to speak to that. I'm not. But I do know that there's lots of benefits to owning real estate. And so I would encourage you to talk to your tax professional about that because there are tremendous benefits. Number 5, we're in one of the best rental markets we've ever been in the United States. Rents are going to continue to go up. What does that mean? You buy a house, a home today. The market's appreciating. You're getting great cash-on-cash ROI. But every year, potentially, if you increase your rents, your ROI continues to climb up. It's a stable market. Stable market and number 8. Let's do those together. Stable market and real estate as a commodity. That's what Ray was talking about through the eyes of a financial planner, what you should be looking for in an investment, stability in what you're investing in, and the fact that it's not a paper stock. It's a commodity. Now, interestingly, when you talk to the hedge fund guys, and especially at the beginning of the year, I did a lot of that because their buying criteria has changed a little bit, and so I needed to get into what they were doing and thinking for 2014. But when you talk to them, you get that same sort of an argument. Hey, this is stable. We know that our investors can invest in real estate, and if something goes wrong in the economy, if we actually go over that fiscal cliff someday, if these things that happen that they've talked about happening for a number of years actually comes to fruition, they believe that, hey, we're in real estate. We're in a great rental market. We're getting great income. housing is going to go back up. You're buying at great prices today. They see it as a stable investment. They see it as a commodity, not a tangible, or excuse me, not a paper asset, but rather a tangible asset. And then finally, they buy because there's great ways to get out. There's great exits. You know, no matter what business you invest in or what product you invest in, you want to always have some sort of an exit strategy. How do I get out when I want to get out? Real estate gives you so many options, not just in terms of when you want to exit, but how you exit when you do decide to exit. So those are some of the reasons why the institutional guys buy, and frankly, they're really the same exact reasons you as an individual investor would look at buying investment real estate. So let's talk about their strategy for a second. It's important to understand this if you're going to make an intelligent decision what to do with your portfolio. Understand what they do. So this is a quote from Jonathan Gray. Jonathan Gray is the CEO of Blackstone Real Estate. So I'm going to go through this. Hedge funds have two different types of strategies. I'll just do them real quick. The first strategy is, what do they buy? What's their buying criteria? And this is sort of how it works. You'll get an email from these guys about every 90 days or so, and the hedge fund manager will tweak what his criteria is. In other words, he'll say, it's got to be at least a 3-bedroom, 1-bath. It's got to be in these zip codes. I don't want to buy in these zip codes. It's got to be a certain age. Can't be older than this. And that, by the way, the age is dependent upon the market. If you buy in Los Angeles, you could say the average age has to be no older than 1970. You can't buy 1970 in newer in some parts of the South or in the Rust Belt because homes hang around longer in those markets than they do in Southern California. But they'll say, you know, the age of the home, the cap rate, I want a certain cap rate. So they'll give you their criteria of what they're going to buy, and I would encourage you to do the same thing. Understand what your criteria is going to be. Their second criteria is, what do they do with it after they buy it? So they've identified how they're going to acquire it, what the criteria is to purchase it, but then they have a criteria of what they do after, what they're going to do with it after they acquire it. Now, I can tell you there's only one hedge fund that I know of, and they're a small one, that does flips. Every other hedge fund buyer is in it for a buy and hold strategy, and the reason for that's real simple when you talk to them. It's because their opinion is basically this. You're buying a piece of real estate under market value, and if you buy it right, you can buy it way under market value, and I'll give you some examples of that in a bit. You're getting great cash-on-cash rate of return, and the market's going up. Why would I sell it? I'll sell it when I think the peak returns, and then I'll sell it. And yeah, there's all kinds of things you hear what these guys can do with all this real estate once the market gets back to where it once was. I can tell you in Warren Buffett's case, I can tell you what he's going to do. It's simple math. He owns Prudential Real Estate. He's going to put for sale signs in the front yard when the market peaks. He's going to sell them. He's going to sell them through the company that he bought. That's a great strategy. So Jonathan Gray, CEO of Blackstone, recently quoted as saying that he believes the market will remain bullish for 2 to 4 more years. We agree with that. We think that that is market dependent. We believe some markets have more than 4 years, some have less than 2 years. I will tell you that a year ago in one particular market that I spent a lot of time in, I thought that market had 3 years left. I'll tell you now, a year later, it doesn't. It's probably got another year left maybe. So it depends on the market, the activity in the market, but that's a pretty good an estimate. 2 to 4 more years, you're going to be able to get great deals. Then he goes on to say that their strategy is to isolate key markets for growth, renovate the properties, and then lease them out. Now, when he says key markets for growth, he's not talking about the number of houses he can acquire in a particular market. He's talking about he wants to be in markets that have space left to grow. In other words, investing in California, or really the Sun Belt states, California, Arizona, Nevada, those markets have come back so strong, there's not a lot of room there still to grow in terms of appreciation. So they focus on other markets. And if you want to really know what markets to go spend your time looking at, look where the hedge fund guys go, because the hedge fund guys have spent, you know, millions of dollars and millions of hours probably researching where the best place to go to buy investment real estate. So look at what the hedge fund guys are doing. And then finally he goes on to say houses have a 94% occupancy rate, and they were trying to build a long-term business here. 94% occupancy rate just means it's a great rental market, which is true. It's a great rental market. And they're trying to build a long-term business, basically just saying that they're in this for the long term. They're not doing buys and flips. Now, I had to add this slide. I just took this off the internet about 10 days ago. But this is for U.S. News and World Report. It's about flips. Now, I know some of you like to do flips. I get people on all the time that say, I really want to do a flip. And flips are cool. If you can get a good flip and you know what you're doing, there's nothing wrong with a good flip. And I'll even describe what some flips can look like in another form here in a couple slides. But I pulled this one up because it's so true, because I was recently involved in a deal that was all about flipping. And there was 2 things that there was errors made in that flipping process. and this is what this article just kind of goes on to say. There's two places you can miscalculate. Number one, what's it cost to rehab it? If you buy something for $100,000, you think it's going to cost you $25,000 to rehab it, and it ends up costing you $150,000 to rehab it, there's mistake number one. Then if you take that to the next end, to the other end of the spectrum, which is what you think you can sell it for, you buy it for 100, you plan on putting in 25, you actually put in 50. You thought you could sell it for 200, but you can really only sell it for 175 or 165. So the two places the biggest mistakes are made at is what your rehab costs are and what you can actually sell it for. And that's the selling price is the slippery slope, because this market right now is not being dictated by appraisals or any of that other stuff, which has been the traditional way to value real estate. Today, valuations is made simply on what can I sell it for. What's the hedge fund guy going to pay for it? What's an investor going to pay for it? That's what. So there's two places you can make mistakes, and so I just love this quote. I put it in red at the bottom. If location, location, location is a mantra for all real estate, then do the math, do the math, do the math is the mantra for would-be flippers. So flips are great. We'll talk about some flips here in a few slides, but understand that there's some pitfalls when you're doing flips. Just some quick news slides here. This is from February. This is from Bloomberg. 77% of investors with at least $1 million in assets own real estate. Goes on to say that real estate's the #1 alternative investment pick for 2014, with a third of millionaires surveyed saying that they plan to buy this year. Now, what does that mean? It just means that folks with a high level of success in this country recognize that investment real estate is a great place to put their money. Again, from Bloomberg, wealthy investors turning to rebounding real estate as the fixed income yields remain historically low and equities surge. Basically, just you can get in low, you can sell high, rates or values of properties continue to go up. Finally, from credit.com, this is a really powerful statement here. This is for 2013. In 2013, 44% of all sales that were made in the real estate market were made by cash, meaning there was no loan recorded at the time of the sale. Now, what does that say? That's just screaming out one thing, and that's investors are buying real estate. It just means that investors see the value in real estate, and this is where they're sending their money. They're buying real estate. Finally, from Prudential, which is, again, Warren Buffett's group, they did a Consumer Outlook survey saying that consumers' perception of residential real estate is increasingly favorable, that consumers are more committed to buying and selling in 2014 than they were the previous year. I think that 2014 is going to be the best year to buy investment real estate, and as we go through the PowerPoint, you'll see why I think that to be true. Now, we've talked about hedge funds. Now, what about you? You're a smaller investor, probably. Generally, the people that attend these calls are generally folks looking to buy a piece of property, or maybe 5 or maybe 10, but generally it's the smaller investor. So how does the smaller investor compete with a hedge fund? Well, I can tell you there's lots of reasons now why the smaller investor can compete on a high level. As a matter of fact, I've been doing email blasts saying, if you want to buy like a hedge fund, take a look at this, because we can get stuff now directly from wholesalers, directly to you, cutting out all the middlemen in between, where you can get great deals, great rates, great ROIs, and great markets. But just a couple things. First of all, you always want to buy below market value. That's the #1 key, and I could say that 5 times. It's the same strategy the hedge fund guys have. You got to buy under market value, and I'll show you some examples again in a few minutes. You got to buy direct from the selling party. I believe that what was once called the specialized REO groups, the groups that formed when the market melted down, these were people that would buy directly from a wholesaler, mark it up, and then sell it to the consumer, which is still fine. There was a purpose that was served there, and that's okay. But I think in 2014, I think that model now is wearing thin. You don't want to buy anything that's not off market. If you buy in the MLS, you're not going to get the best deal. You want to look for both appreciation and ROI. In other words, in some markets you get high appreciation, in some markets you get high ROI. You can get both. The hedge fund guys look for both. You should look for both too. You shouldn't compromise the market that you go into because, well, Charlie, I love the Atlanta market. I'm only getting a 6% cap rate, but it's going to appreciate by 12%. And my response is Atlanta was a great market 18 months ago, but you can get much better deals in other markets now that give you both a good ROI and a high appreciation. You can do both. Have your infrastructure in place. Property management's key. And I'll tell you something, I could do a PowerPoint just talking about the property management business. And has anybody wondered to themselves what's happened to the property management business in the last 5 years? Think about it. All these investors buying real estate, all these investors looking for property managers, these guys are sophisticated groups now. I mean, all your stuff's done online, your billing's done online, you can look at your account online, status of your house online, payments are made by ACH. I mean, these are sophisticated groups. That infrastructure is critically important. And then finally, understand your strategy. We'll talk about that in a couple slides here, but understand what you're trying to accomplish. And what I mean by that is this. If you're looking to do a flip, then understand you're looking to do a flip. If you're looking to do a buy and hold, understand that. Because you know what you don't want to do is you don't want to go into the market with a buy and hold strategy, okay, and then decide 3 months into it you want to flip it because you probably bought the wrong piece of property to flip. Same thing applies to a buy and flip. You don't want to do a buy and flip and then decide you're going to hold it. So you want to understand what you're trying to accomplish before you go into it. Now, I use Ken Corsini's blogs all the time. He's a real estate. He writes for a number of different real estate blogs. I use him all the time. I love this slide because it sort of frames what I'm going to talk about now, which is the best way for you to get the best deals to buy directly from a wholesaler. And I want to describe what a wholesaler is first. Many people think it just looks like that guy in the picture here, which looks like a realtor. Sometimes they're realtors, but very often they're not. Usually they're not realtors. Usually they're in the construction business, the appraisal business. They may have a real estate license. Maybe they're a broker. But a wholesaler is this. I want to paint a picture. He's a guy that's in a market, and he's usually been in that market for a while. He's lived in that market. He's operated in that market. He knows the schools. He knows the streets. He knows the houses. He understands the market that he's in. He understands where to get the best deals. He understands where to get the best contractors to do the best work at the best prices. He is the guy on the ground that's been identifying this inventory for not just people like you, but also people like hedge fund guys. The hedge fund guys, when they go into a market, and I know this, I've done this a number of times, they want to meet your wholesaler. Who's the guy finding the property? Who's the guy in the front line? They're not going to buy from the guy in the middle. They're going to buy from the guy in the front line, the guy that went out, saw the house, walked the house, made the offer on the house, bought the house, rehabbed the house, rented the house, now he's selling the house. That's who you want access to. Now, this is interesting. I found this blog to be kind of cool, not so much because of what it says, because it basically just says what I just said. Buying from wholesalers is the way to go. It was the date that he wrote it. It's 2011. It's 3 years old. Now, what does that mean? 3 years ago, nobody knew how to get a hold of the wholesalers. I didn't. I was working through specialized REO groups like Summit Assets Group and REO Reseller. The best way to get the best deal is to get the deal right from the wholesaler. You don't need the guy in the middle. You get the best deal going direct to them. And how do you do that, basically? You just cut out the middle guy. The specialized REO groups are being challenged right now because those wholesalers that identify those properties in those respective markets are making their inventory available directly to people like you. And how do you get access to that? What we did basically was, and by the way, I saw this coming about 6 months ago now. Well, a little more than that, maybe. It's April, isn't it? Maybe 7, 8 months ago. But I saw it happening in third quarter of 2013 where individual investors were saying, I don't want to, I love the fact, I love this concept, you know, buying real estate for my IRA, through my IRA, great. But I know I can get a better deal if I deal directly with a guy that's got the house. And I saw that starting to occur, and now it's just a reality. The middleman is getting cut out. And what does that mean? It means better deals for you. What did we do? We basically just launched a marketplace, a website, where wholesalers can put their product, show the individuals like you what's available. Now, you're not going to get every detail off this website, but you're going to get some of it. And then if you're based on what your interest level is, we can give you the complete dossier on each property. But we basically created a website in these markets. And these are some of the not some, yeah, I should say that. These are some of the markets that hedge fund guys buy. And we basically just follow that trail. If a hedge fund's there, we know it's a good market. Memphis, Atlanta, Birmingham, Toledo, Kansas City, Detroit. Those are the markets where the hedge fund guys are buying. These are the markets now where you can buy direct from the wholesaler, not through me, not through a specialized group. I'll just focus on 2 markets real quick today, and then I want to get to some questions. By the way, we're going to take questions. I didn't mention that, did I? We're going to take questions at the end of the webinar. So if you have questions, I'm going to open up my slide here and see what we've got going on here. If you've got questions, if you look to the right of your screen, there's a little button there that says questions. If you click on that, we will be glad to answer your questions at the conclusion of the webinar, which is going to be in about 10 minutes. So, okay, Birmingham and Memphis, Tennessee. Now, for those of you that are saying, why would I want to, if I'm in California, why would I invest out of state? It's real simple. You want to invest out of state because that's where you get your best deals. Don't look at investment real estate like the real estate you would own to live in. That's an emotional purchase. When you buy something to live in, it's emotional. You're going to live there. You want to know the community is good, the house is good, it fits your lifestyle, your needs, etc. Investment real estate, just look at the numbers. You're just looking at numbers. It's just like buying stock. You don't buy stock in IBM because they're based in Seattle and it's close to your house. You buy stock in IBM because they're going to be a good return on your investment. Real estate's the same exact way. As long as you can find good infrastructure, and you can, which is the management, it doesn't matter where you own it. You want to own it where you get the best deals. So, for quite some time, CNN Money calls Birmingham the 8th best overall real estate market in the nation, the 3rd fastest growing real estate market in the nation. New Wire Investor says it's the 3rd best cash flow market, and I'll give you some examples why that is in a minute. Birmingham was a sleeper town until about a year ago when one hedge fund showed up, Buy PD. They buy a lot there. I mentioned earlier they put 37 homes or something under contract last week in Birmingham alone. This is not a sleeper market anymore, folks. This is a market that's got another 18 months in it to get great deals, and then it's going to start getting tight. They spent a lot of money revitalizing the downtown. I mentioned that CNN Money at the beginning of the year, they had their top 10 hottest housing markets for 2014. Birmingham came in number 8. Lots of reasons for that. I won't go into all the reasons. We can talk about that offline, what's going on in Birmingham, but it's a booming town, and the real estate market there is extremely strong. Memphis, Tennessee was rated number 10 hottest real estate market in 2014, projected 8% appreciation through September of this year. I can tell you Memphis, by the way, is now rated the number 1 city for appreciation through 2018. So number 1 in America is Memphis, Tennessee, and there's a reason for this too. Memphis is really interesting. It's got strong rent ratios for medium-priced homes. It's got a great, solid economic infrastructure and a stable historic market stability. If you look at statistics in Memphis about the housing market there, it's almost boring. It's flatline. It just steadily grows. And so Memphis, because it did see a downturn as well in 2008, you can get great deals there right now. And the fact of the matter is that market's going to just continue to climb and climb and climb and climb. I did a webinar, as I mentioned, a couple weeks ago with Pacific Meridian Properties. These guys are first-class guys. They actually offer financing on these homes. So if you're looking to do a finance deal, you contact myself or Ray about that. They specialize more in the A-type property. This property here is a rental property at $160,000, a $1,400 a month rent ratio. This is brand new, folks. That's a brand new house. They're actually dealing in new construction. If you're looking for an A-type property, these are the folks you want to talk to. And you can see kind of the quality and the workmanship they have. These are just great properties for rental. Now, these aren't the best cap rates. These are under 10% caps. The market's going to appreciate, but I show this stuff because if you're looking for something that's more A quality, that's certainly available. Now, you go into another market like Birmingham. This house was probably built in 1950, but check out the numbers on this. This is only $47,500. Now, in Memphis, you were looking at homes at $160,000. So you could buy 3 of these. Look at the cash flow. Rent $750. Zestimate valued it at $62,000. E-appraisal at $52,000. You got a projected cash-on-cash rate of return of 12% on that. So that gives you an idea. You're buying under market value and you're getting great cash flow. If you remember, I talked about getting into stuff where you can get both cash-on-cash ROI and appreciation. This is the type of market I'm talking about. $42,900 in this property. The rent is $750. Trulia values it at $102,000 and e-appraisal at $69,000. Your cash-on-cash return on that is almost 15%. This is in the historic district of Birmingham. It's actually a historical community here. It's got a lovely street. If you saw the photo gallery on this, the inside's been completely redone. It looks brand new, and you got a renter in there installed at $750, and you're buying it way below market value. That gives you some of the ideas. Same thing goes here. This particular group here, they're a wholesaler I work with out of Birmingham, 3D Properties, Rob Malcolm. He may even be on today. Rob, if you're there, hello. Welcome today. If you see the photo gallery on this, no joke, if you get a flavor of it, look into the picture to the right. This house looks brand new. I mean, when he gives me the scope of work that he completed on this particular property here, it looks brand new. Everything inside and out is looking brand new. You can see the little yellow sticker still across the front. It was just finished. Now look at this. This thing's renting at $960, and it's selling at $59,900. Trulia says it's worth $80. E-appraisal says it's worth $79,000, so it's probably worth right about $80. And when I talked about flips, that could be a flip. That could be something you could actually buy, hold on for a year. At $1,000 a month almost in rent, you're going to net probably $850 of that. So you're going to put, $9,500 bucks, almost $10,000 in the bank in 1 year, bringing your investment total down to $49,000. Yeah, then you can list that at $75,000 to $80,000 bucks, put it on the MLS and sell it. That could be used as a flip. I wouldn't flip it in 2 days. I would take some of that rental income, take the tax benefits, sit on it for a year and collect some income. I might even let it sit there for 3 or 4 years and let it continue to go up. That house is going to sell at a very high number down the road. That's a great cash flow vehicle at $59,000. Gives you some ideas, and that is my presentation. So I'm going to leave our name and phone number up on the screen. If you have questions, we would love to answer them for you. If you're shy and you don't want to type your question in, we're going to leave our information up here on the screen. I always leave at least an hour after the call to take questions from people. But we're going to leave our contact information up there on the screen. I've got one question in the queue already. And yes, I know, it was very fast. I did that in 40 minutes. And yes, I did remember to hit the record button today. So what do you know? So I will have a copy of this today. I think Ray laughs because I meant to record everyone we did last week, Ray, and I forgot. But I did remember to push the button today. So we did record the video. So if you'd like a copy of it, you can either notify me in this webinar or just give us a call, or you can send me an email even. And we'd get a copy of that out to you. And the next question, I think, would be directed at you. What is the process in buying real estate using your 401k plan?
Well, the first thing you have to do is find a self-directed IRA company that acts as custodian for your money. And then it's really a simple process. There's some paperwork involved, but basically the 401k and the custodian purchase the property on behalf for your IRA. There's certain rules and regulations you have to follow, which are fairly strict. For example, you can't buy a property for your own personal residence. It has to be an investment property. And there are some other guidelines as well. And if you want to know what the details of that are, one of the best ways to find out is to contact a self-directed IRA company. We have, as Charlie mentioned, a couple coming in the next 2 weeks where we will have them actually on the phone. You can ask some very specific questions of the custodian directly. But it's really simple. If you have a 401k now, if it's an old one you had with a previous firm, moving it is no problem at all. Very simple process. If you have a 401k with your current employer, there's still a chance you may be able to move some or all of that money if your company has an adoption agreement, which is basically the document that goes to the IRS that approves the program, or at least notifies the IRS the details of the 401k program that the employer is allowed and implemented. If they allow for in-service distributions inside that document, then you can move your money while you're still in their employ without any problem. It's becoming more and more prevalent today than it ever used to be because there's a lot of liability now associated with qualified plans. So an employer takes a little bit of risk even by offering them because there's a rule on the books called the 404C, which requires that firms provide some sort of basic education to clients, or to the participants in the plan, rather. And if they don't, what's happened is a lot of employees have actually sued the firms for a loss of dollars in a crazy volatile market that we're in. It's really not their fault, but that's the reality of the life we live in today, in the world we live in. So the fact is more and more companies are allowing for that kind of flexibility where if you want to move your money outside the plan, a portion of it or all of the current balance that exists while you still continue to contribute on a regular basis, that is possible. And anyone that wants to see or need my help with figuring out if it is, just give me a call.
Okay, thanks, Ray. And we've got a couple more questions here. I love this question. Are these prices negotiable? That's a great question. I don't think I've ever been asked that before. Yeah, man, you know what? That's such a great question, Ray. How often we have been asked that? And you know what? The hedge fund guys, when I send them a house and I say this is $42,900, you know how often they say, okay, sold? Never. They always negotiate. You should too, absolutely. If you want to say, Charlie, let me see what's your best inventory that you have right now, what would you suggest? I would show that to you. If it's asked at, I think the last one I had up there was $42,900. If you say I want to offer $39,000, yeah, absolutely. These guys they're willing to discuss negotiating prices. Absolutely. Next question, I love this one too. How do you get paid? That's a great question. I get paid a referral fee from the sellers. I don't charge you for that. It doesn't come out of your investment piece. Those prices I quoted there, those are all-in prices. There's not fees in there as well, so you're not going to get another bill for a fee. So no, they pay a referral fee, and frankly they pay you a referral fee. If you referred someone to them, to a friend, a brother, or sister to buy, they pay you the same referral fee. So that's all it is, just a referral fee. The next question, good question. How can we be sure the house has been properly rehabbed and repaired? It's a great question, and here's the answer. You got to ask for an inspection, and you ask for the inspection report to be paid for by the seller. Now, I showed you a couple of pictures there of houses. there's a photo gallery on every property. So you can see the craftsmanship and workmanship that's gone into the property. And they will even do things like take pictures of the new AC. They'll take pictures of the electrical panel. They'll take pictures of the hot water heater. They do all that stuff. But now, can you buy a house from 2,000 miles away, let's say, without, just using photographs? No, I'd ask for an inspection. And that's what generally any of these sellers will do, is they'll say, yeah, we'll get an inspector. They'll do an inspection report. They'll provide that to you. And typically the seller will include in the sale of the property some sort of a guarantee or warranty on the work that they've done. In other words, if they put in a hot water heater, it's going to be warranted for a period of time. If they, changed out some of the plumbing or they put in new sinks, they're going to warranty that stuff. I would always encourage you to consider buying a home warranty. They're only about $300 a year. I would always encourage someone doing that. I've heard really cool stories about people who bought a $350 home warranty and they had a pipe burst and it was all covered under the home warranty. I would encourage you to do that. But yeah, you can get an inspection on it, and you can usually negotiate some sort of a warranty along with the sale of the property. Okay, another question. Do you have homes in the Idaho or Iowa region? The answer is no, and I don't think I've ever been asked for homes in those regions. I don't know of anybody that works that market. So I don't know what to tell you about that. I'm stumped on that one. I'm trying to think of somebody I could refer you to, but I don't even know of anybody in that region, to be honest with you. I do know some folks that work the Portland, Seattle market, but I'm not sure about either Iowa or Idaho. Okay, I don't see any other questions here. Let me just double check, make sure I didn't miss anything.
And Charlie, just as an FYI, for anyone that wants to understand how, in a little more detail than we're able to do today, how real estate fits into an overall financial plan, I would highly suggest that you give me a call so that we can discuss it. It's important, and it's a lot more involved actually than what we were able to cover here today. So I will make myself available at no cost to anybody that wants to have a chat about that.
All right, well, with that, I don't see any other questions. We have another one of these today. It's our last one for me and Ray for the week, so we have one more today at 12 noon, so just in about, just in about an hour, right? Yeah. So we will be back here in 1 hour. If you'd like to join us again, if you'd like a copy of the recorded webinar, I can certainly provide that to you. I want to thank everyone for being on today. Look forward to talking to you. And I'm Ray, as always. Good to see you, my friend.
Always a pleasure, Charlie. Thank you so much. Bye, everyone. Take care.